So we got GMX, we got Gains Network, and we got Cap. All three of these are, you can see up here, it's running on Arbitrum, Cap, also Arbitrum, and Polygon if you want. So if you prefer using Polygon, you can use Polygon on that one. And then GMX is Arbitrum and Avalanche. So if you have an Avalanche, it's going to be the same deal where you would just change your wallet to Avalanche blockchain, and you would need AVAX token as the gas token there. But similarly, you can bridge stuff over and do the same thing from the bridge here. Ultimately, I like the Arbitrum chain. It's just way, way deeper liquidity. So if I'm looking here on GMX, for example, you can see there is $458 million worth of liquidity in this pool available to counterpart the trading. So the main differences now are which dApp do I want to use? dApp standing for decentralized application. So GMX, if I go on GMX, I come up to trade, I can see the offers here are going to be between Ethereum, Bitcoin, Chainlink, and Uniswap, all against dollars. And the main thing to understand about GMX is that GMX is trading perpetual future contracts that settle in the asset that you're actually trading. So when I take a position in Bitcoin, for example, when I close that position, it will close in Bitcoin. And when you look at this perpetual market protocol, the GLP, which is the liquidity pool that acts as the counterpart to every trade here, that GLP is comprised of, here's the composition, and you can actually see, 25.8, that's thousand. So $102 million worth of Bitcoin in this pool, 120 million of Ethereum. You got like 2.5 million Chainlink, 2.5 million Uniswap, and then ass loads of stable coins, 180 million in USDC. You can see 49% of the entire pool is comprised of stable coins, and these 4 tokens are all stable coin assets. So the interesting thing about taking positions in GMX is they can settle in the asset that you're trading and the counterpart that you're taking. So when you're taking, for example, a long position, you can choose any of the assets that are part of that liquidity pool to act as your counterpart, because what happens is if I take, for example, dollar token, if I take a position here with $100 coin, that position is basically indexed at the value of $100 or whatever the value is when I open this position, and that index adds it to this GLP. In the same way, if I'm using Ethereum, I could, for example, take a 0.25. So that's $43 position, and I could take a long position on any of the assets available. So I could use Ethereum to go long Ethereum. But the second that I make this position, when I sign this transaction, it takes the value of the Ethereum, which is currently $43, and that becomes the reference price to this long. It's no longer contingent on the value of the Ethereum, meaning that if, this is $43 right now, if the value of Ethereum went up like 100% and this was worth $86, my liquidity or my position that was opened while it was worth $43 is still counterparted at $43. So you can see.
So you're saying, for example, like say you use like USDC as collateral, right?
Yeah.
And then earlier on, like it kind of depegged for a little bit.
Yeah.
So that risk wouldn't be there then.
Exactly. Since when you take a position on GMX, you're indexing the value of your collateral asset at the time of opening the position. So no matter what happens to the value of the collateral after the position is open, you're opening it, and here you can see where it says collateral in, you're indexing it in US dollars. So not US dollar token or DAI or something, in US dollars. So that's true of your US dollar coin. That's true of your USDT. That's also true of your Bitcoin or your Ethereum. On the short side, though, and this is unique to GMX, you can choose which collateral you'd like to use, which asset you'd like to use as collateral. So you can see, I can click this drop down, and I can choose between the 4 different stable coins that comprise the liquidity pool here. So if I'm taking a short position, let's say short on Ethereum here, and I did $100, I'm using USDC here from my wallet. And then you can see here down below, short Ethereum is going to cost me 0.0017% per hour basically in funding fee or in interest to borrow whatever amount of leverage. Here's the leverage slider. So if I did a 5x on my $100, I'd end up with, this is $500 minus the fees to open this position. So you're ending up with just under $500 worth of a position. And then you'd expect, as long as the position is open, to be paying this interest. This interest changes based on how much the asset that you're using as collateral is being utilized. So if I go back to the dashboard here, you can actually see, here's the composition of the entire liquidity pool. And then here, this utilization rate on the back side, you can see here, Tether, 50% in use. So of the 3,789,000 available in this pool, half of those are already spoken for in positions. Whereas at the same time, Forex, 0.92%. And what that means for me as a trader is that I can come here, I'm using USDC from my wallet. I can make $100 USDC, 5x, and then instead of having it by default collateralized as USDC, I can tell it to use Forex. I'm still supplying USDC from my wallet, but I've now told it to take the USDC, add it to the liquidity pool, the GLP, when I open this order, and then from the GLP, take the Forex and borrow that. And the reason I would choose to do so is down here. Now the borrow fee is nothing. This is free leverage. Like, I can keep this position open for free. This isn't going to cost me any interest at all. So checking basically which of these assets has a better deal tends to be the way to go, especially because even if you personally have a reason not to trust an asset like Forex, which, by the way, Forex is a stable coin that's algorithmically maintained by a decentralized protocol called forex.finance on Ethereum. So it's one of the first and probably the biggest algorithmic stablecoins out there. It is collateralized, I think like 96% or something, with actual USDC or Ethereum or other assets, but it has the ability to be algorithmically generated up to 10% of the circulating supply could be uncollateralized. And that's, like, you can read much more about that, and we can dive into like the Forex protocol someday too. It's really cool. But if you were, say, like, I didn't want to get too deep into that one.
Yeah.
Can you hear me?
Yeah.
Yeah.
So you changed the Frax as collateral and Frax. Now, does that change your short amount, like 497? I didn't understand where that came from. That fees, the fees?
So the $100.
Where does that fees come from?
So there's a fee to open a position and to close a position. So when I first create the position, that fee is basically denominated here, and you should always expect that it's going to be the same when you close. So if I'm doing 100 with 5x leverage, and then lessing 2 times 88 cents, I'm left with 497.46.
I see.
So because it's on the front end, it's taking the open and close fee, so that the profit and loss percentage that it will display once the order is open, that will be accurate without you having to factor in the fee that you're going to pay for closing. So yeah, that's where
borrow fee.
Yeah,
borrow fee is 0% for this.
Yeah.
When it's a value of something, where does it take it out of your balance?
Okay, so so the borrow fee
balance.
as the balance, or as you keep a position open. So let's here, I can open a position actually to show what it looks like. It makes a lot more sense.
Max, should we just like start with the chart and then
let's look at the chart and then see which direction I want to take a position.
Because this might be
the borrow fee.
Yeah.
The question I have is the borrow fee. It gets taken when you close a position. So basically, everything's calculated to make sure you have enough to pay your borrow fee, or is it taken out on every hour, just like
in real time?
Yeah,
it's taken out in real time against your P&L level. So once the position's open, if your funding fees and stuff are counting against it. So even if the price doesn't change at all, if this fee were higher, like for USDT, it's going to be much higher. 0.005, because 50% of this is in use, right? So now if I open $100 position, this is going to start adding to my loss in real time. So, and it is actually like on a per block basis on this one. So it isn't like Some other marketplaces will have like a countdown to when the funding fee is paid every like hour on the hour. With GMX, you're paying the funding fees, or not necessarily the funding fees, but the borrow fees to the liquidity pool every single block. So you're paying that fee like 20 times a minute or something like that. But
Like
it
if you
averages
guys
to this.
look at my screen, right? So this is another protocol that we'll go over, but CAP, you can see there's something called funding, and then this is the fee that I'm paying. It's the same thing.
Yeah,
Like,
exactly.
I don't know.
So the
However-
thing, there is a little bit of a difference between this funding fee versus the one on
Okay.
GLP, because on GMX, on this market that we're looking at now here, this is cap.io, and you can see in the top right corner next to where it says long and short, how it says USDC and 50x. Like, so Sid is using the US dollar, like USDC collateral marketplace. This market is 100% collateralized only in USDC. So when a position is closed, it will only ever settle in the collateral asset. Whereas on GMX, if I close a long on Bitcoin, I can take possession of the Bitcoin. On CAP, if I close a long on Bitcoin, I get paid out in USDC. Because there is only one asset as the collateral here, that means everybody who's taking long or short positions on this order book is taking those positions against the same collateral asset, which means that people who are trading long are paying the interest to the people who are trading short. And in this case, where Sid has a short sell open on Bitcoin, more short sells are open than long positions, and therefore he has a negative funding fee. He's having to pay the people who are maintaining long positions in order to keep this position open. Whereas I can see your funding fee is positive on Ethereum, meaning most people on this platform are currently short or are currently long Ethereum, and you holding a short, which is the opposite of what most people are doing, are collecting the funding fee. So in this model, funding fee gets paid by short sellers to long sellers, and by long sellers to short sellers. And depending on which side of the equation has, more leverage, that funding fee can actually be positive, and you can get paid to maintain a position open, which is really,
Right. This is more traditional.
that will not happen on GMX, because on GMX you're not counterparted against one asset, you're counterparted against the entire GLP. So on both sides the funding fee is negative almost always, or it's just zero.
All right.